Welcome back to the Retirement Fiduciary Podcast, your classroom for no BS financial education. A place where we have authentic discussions about retirement planning, investment management, tax reduction strategies, insurance estate planning, and more. Here's your host, Adam Koos, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group.
What's going on, everybody? Welcome to this week's podcast, the Retirement Fiduciary Podcast. We're in the middle of an election year, and this is my fifth election year, I think. Yeah, fifth election year in almost 23 years of doing this for a living, helping people with their retirement savings, helping them make work optional. And, it's never fun an election year. We have the deal with the commercials, which thankfully we can mostly avoid through the beauty of DVR and streaming services. That being said, of course, with streaming services now, and you can't even avoid the ones where you have to wait 5 seconds or even 20 seconds before you can skip them. And of course, it just seems that the more time that passes, it almost seems like the candidates just keep getting worse. I remember when I was a kid, hearing my dad say that, it's the lesser of two evils. But when I think back to the candidates back then, candidates back in the 80s and 90s, I just think it's at least it wasn't such a reality show like it is today. But I digress. Today we're going to be talking about investing in an election year, giving you some truth, behind the scenes of what's going on here. Because I think that the more that any of us watch political news, whether that be CNN, NBC, ABC News, CNBC, obviously financial news, MSNBC, Fox News, any of these news stations, I think it's easy to get caught in the excitement, for lack of a better word, which really is probably more depressing than anything else. So let's filter through all the noise and let's talk a little bit about the reality of investing in an election year. As you all know, I like to start with a quote, and today's quote is Warren Buffett. He said that markets tend to overreact to political events in the short term, but cooler heads prevail over the long term. And in response to that quote, I would have to ask you to ask yourself, do you think that watching political news on whatever your favorite news station is, do you think that watching political news helps you get or keep a cooler head? And if the answer is no, which it probably is, then chances are you probably should turn the TV off and focus your time on something else, maybe a whole lot more valuable than staring at something that's just going to make your blood boil, easy for me to say, and stress you out and get you all fired up. I mean, that's not good for us. It's not good for our bodies, our health, our longevity. So markets tend to overreact to political events in the short term, but cooler heads prevail over the long term. So be one of the cooler heads, I think, is the lesson here. So the first thing I want to show you is the seasonality of the market in election years going all the way back to 1948. So we got several years in here going, basically averaging out all those years and what it looks like. And when you look at all election years, and for those of you listening on Spotify or Apple Podcasts, I'm going to talk you through this, but for those of you watching on YouTube, the black line here is all election years. And you can see that the first half of the year almost, so through May, the average election year tends to kind of go nowhere. I mean, it tends to be flat for the most part until almost June, at which point the market has a tendency to pick up and start to grow northward until about September, at which point there's on average a correction between September and the end of October. I'll even call that a pullback. It's not even a correction. It's a drop of about 4%, 5%. And then it tends to head northward through the end of the year, from end of October through the end of the year. When we look at an election year where we have a sitting president running for re-election, the market tends to do a lot better. In fact, the average rate of return for an election year where we have a president running for re-election is just north of 12%, almost 13% per year in those election years. When we compare that to the average election year having nothing to do with a sitting president running for re-election, so this could be an open field where we got two new candidates. This is the average is somewhere around 7%, just north of 7% per year. So the average rate of return for a year like the one we're living in is actually really good. And in fact, so far this year, the market has done extremely well. In fact, it hasn't mapped or mimicked the averages. Normally in an election year where we have a sitting president running for re-election, we tend to see the market on average go up almost 4% up through mid-February. Then it tends to pull back between mid-February and mid-March, and call it end of March, almost back to even and back to zero. And then it tends to, chop a little bit. There's a little bit of volatility over time, but generally speaking, from toward the end of March through the end of the year, the market tends to do extremely well, with a very, very short time period between September and October where things are a little choppy but flat. But otherwise, when you look at the different scenarios, over which we could have an election year, whether that be sitting president running for re-election, whether that be an open field, whether we look at all election years as an aggregate, it's the best scenario. The only bad news, I suppose you could say, is that this year we saw the market do pretty well right up through the end of March. Then we saw a pretty big pullback in the market between March and I'll call it the end of April. And then since then, we've pretty much seen it go up again, and it's done extremely well. So the question, as you can see here on the chart for those of you watching on YouTube, is, are we due for a little bit of a mean correction in price? Meaning, are we due for a pullback or even a market correction sometime this summer, if we believe in mean reversions and that things will revert back to the averages? Because right now, as the market stands, the market's done better this year through 6 months than it typically does an entire year, an entire 12 months. So we're just going to have to see what happens, obviously, and be prepared for all circumstances. But this is the S&P 500. I also wanted to look at the NASDAQ, which is obviously a little bit more aggressive index, we'll say. Similar situation, except the numbers just look better. So in an election year, on average, the market goes up right around 9% per year during an election year for the NASDAQ. And that's just on average. That's all election years. If we look at a sitting president running for re-election, however, that number is even better. We're talking, 18, 19, actually north of 19%. So 19% per year. But again, where we're at right now, this year so far, is the market is almost at that 19% year to date on the NASDAQ. And as a result, we have to ask ourselves, and by the way, I'm recording this at the end of June, so it's being published mid-July, but this is going to be old data by the time it hits your screen and hits your podcast channel. But again, same question. Are we due for a reversion to the mean? In other words, are we due for a reversion to the average? And when we look at the NASDAQ, I'll go back to the S&P in a second here, but when we look at the NASDAQ, what would a mean reversion look like? Well, let's just say it took the market maybe, 2 months to revert. Let's just say we saw like an 8-week correction or a 9-week market correction. That market correction would take the market from where it's at right now on the NASDAQ, and it would drop from somewhere in the ballpark of, call it 17.5%, we'll call it 18%, we'll just call it 17%, make the numbers easy, down to somewhere around 9%, 9 or 10%, we'll call it 10. So it would basically be a 7 to 8% drop from where we are today over the course of the next 2 months. And would that be the end of the world? Of course not. I mean, we've seen drops of 7, 8% several times in the last, call it 5 years. We've seen drops like in 2018, fourth quarter, the market went down 20% in 52 trading days. So we've seen things that are much, much more, call it hurtful than that. That's for sure. And of course, I don't think any of us can forget COVID, where the market went down, 34%, I believe it was, in about 22 days, 22 trading days. So a drop of 7%, if it were to revert to the mean, by the way, that's if it even does, would only be a pullback. It wouldn't technically be considered a correction, because corrections are defined as drops of 10% or more up to 20. I don't know who gets paid, hundreds of thousands of dollars to decide what these numbers are and where the breakpoints are, but it is what it is. Those are the definitions, so that's what we're using here. And if I go back again to the S&P 500, which is probably a more broadly used benchmark for the stock market here in the United States, with the market being up around 15% or so, a drop to the mean over the course of the next 2 months would be, let's see here, about a drop of maybe 6%, something like that. So right around 6 or 7%. So not quite as bad as the NASDAQ, but still a pullback nonetheless. Nothing horrific, nothing that's going to make us have to go back to work, or at least it shouldn't. That's for sure. So that's the first thing. The second thing I wanted to share with you today is, and by the way, all this is from Stock Traders Almanac, Jeff Hirsch, just great research. I've been a subscriber forever, and will probably be a subscriber forever. But Jeff Hirsch came out with this chart the other day. He calls it Christmas in July. And it's really interesting. The NASDAQ, even though we're already talking about, or we just got done talking about, the possibility of the market pulling back or reverting to the mean, which would be a drop of, 6, 7, 8%, depending on which index you're looking at. Whereas we look at this chart here, and that if you look at the NASDAQ since 1985, he says Christmas in July because the market has a tendency to go up quite a bit from the end of June to the middle of July. There's this big jump, and the average is this. It goes from being up right around 7% year to date at the end of June to being up almost 10% at the call it mid-July. So we're talking about a 3% jump almost on average, and that's the averages for a 12-day mid-year rally from 1985 to 2023. Those are the averages. So it's funny. We have basically mixed messages here. On one hand, we have averages that are telling us that the market's gone up a lot faster than it normally does in an election year. So therefore, it's possible, if not probable, I don't know, it's a big question mark, that we could see the market pull back and drop, call it 6, 7, 8%, if the averages are to ring true by year end or even by the end of the summer. On the same hand, we have these statistics that say that over the course of the last several decades, we've had this big jump of 3% from the end of June to mid-July. And the same averages, by the way, on the NASDAQ, just as an FYI, once that jump of 3% takes place through mid-July, the market has a tendency to pretty much go nowhere, over the course of the next 1, 2, 3.5 months. So once this happens on average since 1985, we tend to see the NASDAQ just pretty much creepy crawl sideways. And in November is when it kind of starts to head back up again toward the end of the year in the fourth quarter, which, on average, the fourth quarter tends to be the best quarter for the stock market on average anyhow. But that's the case for the NASDAQ here as well. So that's our election year update so far. I'm sure we'll have a whole lot more to come as the months move along here. There's going to be a whole lot more to talk about when it comes to the election as the debates continue and as the stock market continues to teach us and tell us what we need to do and how we need to be reacting to it. And I think that's the whole point here, is that we need to be prepared for all circumstances, but we need to not predict. We need to always be prepared, but never predict. We always need to react and be ready to react and adjust our portfolios and our financial plans and retirement plans according to the market landscape and the prevailing landscape that the market shares with us. Because anybody who tries to tell the market what to do, it's just a losing battle. But if you listen to the market, if you watch it, if you pay attention and you react, you're going to be a whole lot better off than just sitting tight, sitting on your hands, and just letting the current take you. So with that being said, thank you so much for joining us. If you have any questions, feel free to reach out. You can reach us at info@libertaswealth.com. If you'd like to check out our website at libertaswealth.com and inquire on setting up an intro call to get a second opinion on your retirement plan, your investment portfolio, we'd love to help out, at least have a chat at the bare minimum. But our process always starts with a phone call, very non-threatening, just chit-chat, get to know you a little bit better, explain our process and how we work with our clients, and then determine whether or not it makes sense to even move forward from there or just part as friends. You can just check us out on all the social medias, Adam D. Koos on Instagram. We're on Facebook at Libertas Wealth. We're on on Twitter, which is also X now, at Adam Koos and at Libertas WM, as well as TikTok, our newest account, at the Retirement Fidu. It's the Retirement Fiduciary technically, but we ran out of characters, I guess. So we also have a sister company for those of you who are business owners, and a huge team, what we call our success team. The website is elevateandexit.com. We also have a podcast for Elevate aimed directly at business owners exclusively. It's the Elevate Your Business podcast on YouTube. We're also on Instagram on Elevate. That's Elevate and Exit, as well as Twitter, again, Elevate and Exit. So thank you so much for listening. As I always say, there's thousands of podcasts out there. You chose to give ours a listen today. So thank you so much for joining us, and we'll see you next time.
Thank you for joining us on the Retirement Fiduciary Podcast. To see any charts or images that were mentioned on this show, to check out additional articles, videos, and other educational resources, or to set up an intro call with your host, Adam Koos, just head over to libertaswealth.com. This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. None of our shows engage in rendering legal, financial, tax, or other professional services. always talk to a certified financial planner or fee-only fiduciary financial advisor before implementing any of the ideas shared in this episode.